Hello and welcome to the paid weekly recap for the week ending November 28th, 2025. I'm Keith Harwood, CIO of Yellow Tunnel, and also pictured is Vlad Karpel, the CEO and founder of Yellow Tunnel, and the creator of the artificial intelligence behind the paid weekly system. Normal disclosures before we get started. Options involve substantial risk and are not suitable for all investors. Yellow Tunnel and myself are not investment advisors and not registered with the SEC nor FINRA. The information in this presentation is for education and information purposes only and should not be considered trading advice. And finally, myself and/or the team at Yellow Tunnel may have a financial interest in the securities presented in the trade ideas. If you need more time with the disclosures, please go ahead and pause the video here, and I urge you to take a look at the characteristics and risks of standardized options available at the link here. All right, so for the week, we had a bit of a drift down in the 10-year yield, expectations of rate cut in December. Everything seems hunky-dory here. We're not getting into a spot where the 10-year yield is falling because of concerns over economic growth. Now, the big concern for me is with 10-year yield low, if we do have weak non-farm payrolls on Friday, that may start to trigger some concern. If we start to see inflation, that may trigger some other concerns. So as we start to get some new economic data, particularly non-farm payrolls on Friday, after a lack of that data during the government shutdown, I think this picture becomes clear. And then we determine if the market can go into a traditional Santa Claus rally, holiday rally to new highs to finish the year. We started that off this week. We bounced off the lows on Friday, bounced off the 100-day moving average, and then just kind of chugged along throughout the week, slowing down into the half day on Friday. Day off Thursday for Thanksgiving, half day Friday, closing on the highs. Not quite to all-time highs, but certainly showing a lot of strength, and that once again, the dip being bought worked. And this is continuing to train the market on the same thesis. Buy the dips because it works. The question becomes for all, what's enough of a dip? It wasn't the 50-day moving average, although for 3 days it worked. For now, it's the 100-day moving average because for 5 days it worked. We'll see if we make a new high, see profit taking once again, or just actually get to a new high breakout and then drift higher and start a real bull run here. Been a choppy bull market. Recently, we've had the 50-day moving average providing support. That finally breached a week and a half ago. Now it's the 100-day moving average for main support. On the next dip, if we bounce off the 50-day moving average, then that creates the new support level again. But for now, it's the 100-day moving average with resistance at the all-time high. All right, so overall, bullish looking market. Looks like a new high may be in order, and maybe that target price of $700 for the end of the year for SPY comes into play. Tech also bouncing back, but not quite as aggressively. So we've been some rotation within that recovery. Tech not the leader right now. We've seen big drawdowns in stocks like AI names, quantum computing, some of the heavier growth focus of tech, and that has not fully recovered yet. So once we see some of that focal point that has been the key driver of tech stock price growth resume the uptrends, I think that there's going to be a lot more confidence, but that kind of comes hand in hand. Confidence leads to buying AI and quantum computing and things like that. Buying AI and quantum computing leads to confidence, and it's a bit of a loop. And which one comes first, the chicken or the egg? Small caps, on the other hand, had a weakening spot that got below the 100-day moving average, not the support there. Now it's just a flat price of 230 and is very close to the all-time highs. Less of a trend here recently. That we did have a trend for a few months in August, September, and into October, but this has been a slower moving sector overall. Been a benefit factor of the rotation, though. And healthcare in particular has been really dynamic, rallying quite a bit. We'll see if that money flow continues into small caps to maybe change the leadership of this market into the end of the year as people look for rotation and what stories really play out for 2026 investment themes. And then finally, we had the VIX. The VIX got down to 16 and a quarter, 1635, after spiking to near 30. This week was the big drop. We started the week with a high VIX. We ended the week with a low to mid to low level VIX. Now we can get down to 14. We can get below 14 with a new all-time high. But there's been a constant desire to hedge, and it's been working as long as there's been trading around that hedge. As we get to highs, buying puts with the VIX low has worked unless those puts are never sold or dips are not bought. So it's an active trading hedge as opposed to a hedge and hold. We'll see if that continues again, but I do expect to see some demand for puts and maybe some financing by selling out of the money calls to hedge positions as we rally, lowering some of the premium. Now, speaking of premium, our final trade on the long call position outright with no put credit spread was NUE. It was a holdover from the previous week, and we did have a rally on Monday. Turns out would have been nice to hold out through the week, but we rotated into the new trade philosophy starting Monday morning. Now, NUE still had a nice return, 35% gain in the 6 calendar days for the options, the December 155 calls. So done with the NUE trade, nice profit. Again, would have been a bigger profit holding throughout the week as the market was rallying, but so be it, still a profit and a win is a win. Now, switching tones, we started the week looking a little bit weak in Albemarle. Now, ALB had fallen down towards about $114 a share. Tuesday just took off. All right, so it was a good day on Tuesday that really paid off for the put credit spread entered on Monday morning. Looked at some technical support levels, looked at all the momentum, saw the inside day, looked for the put credit spread there, the 112, 111 put credit spread for the week. Now that was able to be sold for 33 cents credit. It expired worthless. So as a return on capital, that is 33 cents on 67 cents of risk. The max risk is the difference in the put strikes. So max risk was $1 minus the 33 cents initially collected, 67 cents, and that leads to a 49% gain in 3 days. Now, a call in this one scenario would have worked out even better, but of course, that's unknown. That 49% gain can be taken in from a flat market condition or bullish. And in this case, Albemarle was quite bullish, a nice return for the stock for the week. Nonetheless, still significantly better than even just buying the stock, which had a 10% gain for the week with a 49% return on the option put credit spread. The other trade we had was Gilead. Now, Gilead was looking really strong, holding momentum here. On Monday, it actually started higher and closed lower. Now, the main support looked to be about 125, but with the bullish start to the day on Tuesday, it was looking like a 126 level near that 10-day moving average would hold. And so we looked at the put credit spread for the 126, 125 for the week. Now that was able to be entered for a 25-cent credit on Monday. Of course, it ended up actually getting a higher price throughout the week as the stock stabilized. But with the 1% drawdown in the stock from the open on Monday, this ended up being a small loss of about a dime. So a dime on 75 cents of risk is a 13% loss. If one had looked at this as a long call position, I just did an evaluation of it, it would have been a significant loss. So just to note here, the $130 calls expiring in December for Gilead were down over 50% from the Monday open to the Friday close because of that VIX drop as well as the price drop. So this is significantly improved performance there, and this is the reason that we switched that focus to the put credit spreads. Had we gone with calls for both Gilead and Albemarle, the big win in Albemarle would have actually been partially offset by that bigger loss in Gilead. And in this case, we ended up having a nice return in Albemarle and a little bit more consistency. And then that Gilead loss was small on a relative basis. Actually, if it had been held all the way to the close, would have been a small profit. But of course, you can't hold these positions all the way to the close because they do expire and there's assignment risk and everything else. So taking the smaller loss there, certainly worthwhile. Good end up net result for the week for paid. Really liking the shift in focus here. One note, because of non-farm payrolls, it's unlikely that we'll be looking at a trade today for paid. Non-farm payrolls week does tend to have a bigger input on it. Having those big fundamental inputs can be a problem for some of the momentum signals that we follow. So we look at other ideas through our trading room. Vlad and I talk from 9:15 till about 10:30 Eastern every morning for the morning bell, the closing bell from 3 to 4 Eastern. Please join us. We'll talk through a lot of ideas, some trades that maybe look to be exited prior to non-farm payrolls, some earnings ideas, etc. The performance has been great for the live trading room. You can always ask questions about the paid signals or anything else that you're looking at in the market. So I urge you to join us. Take a look at the opportunity there. We also have recordings on the site if you want to take a look at those. And if you want to just reach out to us via email, I'm Keith at yellowtunnel.com and Vlad is Vlad at yellowtunnel.com. Thanks again, everybody, and looking forward to an interesting week for this market and maybe some more clarity after we get non-farm payrolls on Friday. Thanks again.